Brokerage, the channel for learning about trading and investing. Welcome to quick market analysis for tomorrow, April 18th, Thursday, 2024. So today was a trading holiday, and the last trading day yesterday, it was a continuation of the slide down retracement that was happening since last 3 days, and it's 3% loss now. Market is looking for supports, or is it going to get into deep overreaction? Let's try to find the answers to that in this presentations. So we'll come back to this wrap up slide once after we have seen the charts. Here are the plain charts of let's see the candlestick, right? See, this is the candle that is formed yesterday. You can see that this is mostly a small body, not exactly a doji, but it's indecisive regardless. Any indecisive candle clearly indicates the market is very confidently sliding down, if at all that's a trend, and there is a big bull and bear fight that's happening. That's indicative of the small body. The big size on the top says that. So this is the candlestick that we get. It's like a spinning top with equal size wicks almost. Small body indecisive, that's what you're doing to. And more importantly, it is a gap down. Gap downs or pro gaps, what do you call bearish kicker. And that's what pro gaps are. That is intense bearishness, and that's happening since the last 2 days. It's a kicker yesterday and it's another kicker yesterday. So it's clear bearishness, and candlestick alone, if you see, it is close indecisive. In the case of Banknifty, also we see a third day of gap down, and the candlestick looks almost like a spinning top to small body with equal size wicks on both sides, indicative of the indecisiveness in the market and the intensity of the fall, or a gap down or a pro gap that's formed indicates that there is bearishness. It's continuing to be there in the market, but it has managed to close above the 50 exponential moving average that comes somewhere near to 47,150. Similarly, Banknifty, Nifty, which had lost the 20 exponential moving average yesterday, the previous trading day itself, also seems to have taken some sort of support at the 20 to 100 zone of the 50 exponential moving average. That's where it is. Now, if you look at the price versus the trend line channels, you can see that it is now at the bottom of the trend line channel, the inner one, and a breach of that would mean that it may be sliding towards the outside yellow colored trend line channel, and also there is a possibility of a swing low getting breached, and the higher high, higher low pattern which is being maintained can get breached. So until that happens, we still may be consolidating, and if that happens, that means if price is going below the 21,700, say for example, would indicate that the pattern is breached, and if the close happens that way below 21,700, we can clearly understand that this correction may extend further. Right? The pattern itself turns, price action patterns change into bear zones. Now if you look at to study the resistance support levels, you can see that the immediate resistance is the 22,259. That's a gap that's formed during the gap down in the previous trading day. That would be the main resistance. After that, you have another gap at 22,503.75. So that was the immediate resistance, and after that you have 22,775. Now closing above the exponential moving average of 22,350 is crucial, because that's going to be another major resistance. So just to wrap it up, 22,259, 22,350, and 22,500 are the immediate resistances. Downside, the supports first could come in at 22,000. It's a big rounding number. It is currently taking the support at 22,100, and if that is breached, it gets a support at 22,000. This is a big rounding number, and a breach of that take it to Fibonacci 20x retracement levels that comes somewhere at 21,862, and swing low very close by that is at 21,750. Right, a breach of that 21,700 would be would mean that the next support would come in at 21,603. So that's the support resistances for the Nifty. The Bank Nifty, you can see that it's currently inside trendline channel, while an outside trendline channel is where the all-time high was made, and it was trying to break out of the 50,000 levels. But the inside trendline channel met with the resistance, and that's where the fall began. And now it seems like it is heading towards the bottom of that inside trendline channel, which could be somewhere at 46,700 nearby levels. So the first support would come in at 50 exponential moving average, which is at 47,154, and then the next support would be at 100 exponential moving average at 46,590 nearby. But before that, we have the 47,000 big rounding number support also that can come. Now 46,587 or 46,600, if that support is also breached, there is a close by 50 exponential, 38 exponential moving average. Fibonacci extension levels are there somewhere at the 46,400 levels. That is also breached. Then 200 exponential moving average at 45,679 is where it may be heading to. That's the support on the downside. On the upside, the gap that's formed because of yesterday's gap down at 47,725 would be the first resistance, which is also in confluence with the 47,700, which has got a 20 exponential moving average. So 47,700 is the first crucial resistance. After that, 48,000 big rounding number resistance is there, and then 48,477 resistance is there. Right, so that's the resistance on the upside that the Bank Nifty may be having to deal with. Let's just wrap it up with the slides. So it was a gap down for the third day. The fall was comparatively lesser, on like 25 points, little more than 0.5%. Remember, we had a rally of 35 plus points, and 4.5% correction has taken today to 150 nearby. It's a small body, we have seen that. Bank Nifty, the banking index also has gapped down for the third day with relatively less cut this time, less than 300 points, 0.60% negative, and this close below the 20 exponential moving average. Even Nifty also close below the 20 exponential moving average, that way it's negative. It's 47,485, just less than 47,500 is where it is. Total retracement so far during this pullback is 3.5% Nifty and 3% nearby. That's not a big deal. Intraday price action, if you look at it, you can clearly say it was a gap down, and then it was range bound. It was not severe fall on the last trading day yesterday. But that was not the case in the previous 2 days. It was very volatile and intense falls. Big sell-off. The big sell-off did not happen. Sharp sell-off did not happen in the last trading day. It gives little hope for the bulls. Levels we already seen. I'm not repeating that. So let's try to put what's in favor of the bulls and what's in favor of the bears. So higher low pattern is maintained, is good. While Japan has still not expanded on the downside and contracting, indicate side moves is good for the bulls. Sectoral indices, there is some green, half green is there. But IT metal reality is still red, but there is some green on the other major sectoral indices. And momentum in the daily short-term time frames, if you see only the IT has fallen to the bear zone, so these are hanging on either in the bear zone, bull zones, or in the side zones. So that's also goes in favor of the bulls. Heavyweight stocks are close red, that's actually bearish, but the fact is that HDFC Bank and Reliance has closed green. Right? That gives some hope. At least some green, and also momentum in the short-term time frames. If you see for the heavyweight stocks that contribute maximum to the index, if you see only the inferior slipped in the bear zone, so those are all just hanging around in the sideways momentum and not acting in the bear zones, or some of them are even in the bull zones. So that way, heavyweight stocks that contribute maximum also goes in favor of the bulls some way by the last day's performance of the last one. What goes in favor of the bears is the fact that momentum has dipped. Now has slipped. RSI is below 40. Is not coming, but the RSI is sideways, slipped from the bull zones. That is what has happened. So it's not bearish yet, but it goes in favor of the bears because of the fact that the market was the all-time high with the RSI bull zone that has slipped and confirmed that sideways motion now on both the indices. Trend indicators have crossed over the bear zones or DMI negative zones as well. The trend indicator ADX. So that's the trend in the momentum price action, and the price is closed below the 20 exponential moving average, is also short-term negative. And this candle formation is indicative of a breakdown that has happened with a gap down for the third day. So that is also not so great news for the bulls. VIX has spiked a bit less, but it did spike for the 1%, and 12.61 is where the India VIX is, which means that it's gradually building up and moving up when the market is sliding down India VIX. So that gives a warning signal of getting out of the low volatility regime that we were enjoying for the last few weeks when the market was rising up. Now, if you look at the US indices, the mother market indices, Dow Jones index has fallen nearly 6%, and other indices like the S&P 500 and Nasdaq also has slided down 4% from the top. Remember, US markets were also rallying because there's quite a retracement that's coming in. If the retracements are extending, and obviously our markets also will reflect that in some way or the other. Dollar is showing some green. It's at 106.6. That's already spiking up, and rupee remains weak at 83 plus, being managed by the central bank. That's all good news for the economy. Crude oil has around 1% down. Some cool off has happened, but it has been spiking up for the last several weeks, and with bullish momentum slightly slipped in the short term sideways momentum for a day. So it's still at 84 plus at the top of the trend line channel top. So that way it goes in favor of the bears. There is a concern the Middle East crisis happening, and oil prices could expect to break out of that channel. Means we have an oil importing country like ours will have trouble and visibility reflect in the markets. Gold has been breaking out, is showing some red as of now, some cool off, but at the very top, normally with the bull zones and all-time highs, absolutely gives us a worry if the money is getting shifted to safer havens or not. The Fyers had been selling ferociously. It's at 4,468 crores in the cash market selling that had happened the other day alone, and 16,000 crores gone, 3% of the market down in the last 3 days. 16,000 crores selling by the Fyers alone, following the FBI Mauritius news flow that came in, which is not in favor of the foreign interests. Even otherwise, the Fyers had been big sellers since a very long time. They've never been buying for the last more than a year or so, more than a couple of years or so, probably more than that. No steady buying has come in except for a very brief period of time. But domestic institutional, therefore, the retail money has been holding the market for the last 2-3 years like this. Now the levels to watch for tomorrow's weekly expiry, if Nifty is 22,000 and 22,500 by the highest put and call resistance, quote and call writing is seen, right, as per the latest data. 0.62 PCR for the options, it's negative, it's bearish. It's not bullish, definitely it's not bullish at all. Futures are also having a bearish build up. It's long unwinding is what we can see on the futures are. So that way, options data and futures are data, open interest data is giving a negative and bearish view for the next day. So that's how it's put in. You can take your call. The verdict from my side is that the retracement is happening for the third day with a gap down and a small body. This is close, giving away the price momentum and the trend gains, but there is a chance that price can take support at these zones because it's in the trend line channel bottom, the inside trend line channel that we are talking about for both indices. That way it's consolidation that is indicative with the Bollinger Bands, and although market has been shifted to the short term, has been kicked down from the bullishness. It's not bearishness actually, very mild bullishness has come in, and it can extend to solid bearishness if the momentum slips below the 40. That has not happened. So this retracement may not be too much of worry, although we don't have a bullish momentum anymore. The higher high, higher low pattern is still intact, and if that is breached at the levels that we talked about when we were discussing the support resistance levels, then we have trouble. Otherwise, investors, all of these deeps can be good long-term investment quality stocks in SIP mode, or you can go for the rental options, regular income strategies. That is where the playlist, you can check out that YouTube channel. The traders, directional or long directional is the question. Right now, it's not directional yet, neither on the upside nor on the downside, sideways. So, forward TMs with slight caution on the put side is what option writers, option sellers will have to play out right now. For directional downside, let wait for the other side normally to fall below the far side 40. But even when you do that, you have to be extremely cautious given the fact the volatility can spike up to 15 plus and 20. So as it does that, you just have to control your position size and manage your risk in the portfolio level and the trade level. So that's the only thing that's enough. Others are all probabilities. Now we have the Mauritius FPI policy change, that is net news flow, the Fed speeches that's coming this week, earnings news flow that can come next week or this weekend, Middle East crisis that's happening. All this could screw up all the technical analysis, and then market can crack down and have black swan can come in any time. So I'll be careful, manage your risk, protect your risk, right? Rest is all, no portion size, manage it. That's all that we can do. Right? That's all I have for the next day. Happy trading, happy learning, happy investing. Bye bye.